Well, now to look at some of the broader themes dictating the market sentiment this afternoon. Geoff Wood from Morphic Asset Management joins me now, fund manager. Geoff, thanks for joining us. Now, let's talk just a little bit about the budget, because this is a post-budget special. Yep. We are seeing very much these reactions coming in just the last little while, and Macquarie is now saying that they're a little bit uncertain about how the levy on their liabilities, whether it will be included, some of their foreign liabilities. The other banks have made some early comment. They're clearly very angry about the move, which was they were not consulted about. But obviously it's a new tax, which they're saying will have to be widely spread. The pain will be widely spread. What's your view on this?
Yeah, I think at a high level, ultimately, if you add costs to the banking system, at some point it will find its way through to the end user, and what we'll probably see is an increase in things like mortgage costs, which are on top of the sort of increased regulatory and capital burdens that the banks have been put under. Yeah,
so sorry, you reckon we will see higher mortgage costs? They will pass it on to mortgage customers?
I do, yeah.
All right, even though it's not supposed to be on that sort of lending?
Yeah, I just think ultimately a bank will attempt to protect its margins, and the only way to do that is try and increase the revenue line to offset it.
Yeah, exactly. And I mean, you know, there's other regulatory pressures on the banks. And now, I mean, just on the budget as well, it seems to have fairly sort of, I guess, heroic sort of assumptions around wage growth.
Yeah.
Do you think they're credible?
Not really. I mean, this I'd say is one of the question marks that sits over the budget, and the premise that they can get back to a surplus by sort of 2021. And that's this idea that we're going to see wage pressures rise. Now, if we look across the world, it's just been so hard for the actual sort of staff to actually increase their demands in what they get paid post the GFC. I mean, there really has been a shock to the system, and globally there's just this excess supply of labour, so it's very hard to get any pricing power, and Australia is no different in that regard, and wage growth here is slow, so you've probably got to assume that that's actually going to come unders and be closer towards sort of 2%.
All right, now there were also, you know, everyone's taken good news out of the infrastructure spend, but how does that fit in with sort of the overall growth figures?
I'd say it's a move in the right direction, and it comes at a very good time. We've got the Sydney and Melbourne property markets sort of topping out as these sort of bank impacts come through that we've just discussed, and at the same time we've seen commodity markets, particularly iron ore, retrace a lot of their gains that they had last year. So if you look at the stalls or the legs that underpin the stall of the Aussie economy, the housing market and commodity one doesn't look so strong as last year, and so we do need this infrastructure pulse to try and sustain the current trajectory of growth.
All right, Geoff, just what are you watching ahead for?
Right now I'd say the big thing this week is retail sales in the US. The big Q1 story was everyone was optimistic, whether you asked a consumer or business. They thought things were looking very rosy, but ultimately they didn't back that up with spending. So the story was that there was bad weather, tax rebates were delayed, therefore the consumer was under some pressure and didn't spend. For that story to be correct, what we need to see is strong retail sales, i.e. a bounce in that, and that data comes out on Friday, which will give us a very good insight into how the second quarter is looking in the US.
All right, Geoff Wood from Morphic Asset Management, good to get your perspective. Thank you.
Thanks, Ellen.